All right, we're going to take a look at some note receivable transactions. So we're going to take a look at exercise 9-18 and 9-19 in the text on page 348. So if we look at 9-18 on December 13th, they tell us that we accepted a $9,500 45-day 8% note granting Miranda Lee a time extension on her past due accounts receivable. So this means that we had somebody set up for an account receivable, they didn't pay, so now we're going to issue them a note receivable where we're going to be able to get some interest. So we're going to debit notes receivable and credit accounts receivable, moving this $9,500 from an account receivable to a note receivable. So next, on December 31st, time has passed. So we're going to accrue interest. So we signed the note on December 13th. Now we're at December 31st, so we should be able to earn some interest on these 18 days of time the note was outstanding. So if we look at this, we take our $9,500 multiplied by the interest rate, which we're told is 8%, and then we convert that into a daily rate, 18 over 360. We end up getting $38. So if our entry on December 31st would be to debit interest receivable and credit interest revenue for the $38. This allows us to recognize revenue that we earned for interest from December 1st through December 13th through December 31st. All right. Now we move on to exercise 9-19, which is a continuation of 9-18. So we're told on January 27th, we got paid. Right, we received Lee's payment, principal, and interest for the December 13th note. So what do they pay us with? Well, we get paid with cash. Cash comes in, it is a debit. We're going to credit interest receivable, which is our number from the 31st, our interest receivable. So we're actually going to get paid on that. We're going to recognize more interest revenue, and then we're going to credit the note receivable. So the note receivable was for the $9,500, so we're going to credit $9,500. Our credit to interest receivable is going to be the interest we accrued at the end of December 31st. So we're going to credit $38. So our note, we have December 13th, we have January 27th, and we have December 31st. So December 13th to the 31st we know was 18 days, and it was $38 of interest revenue. Now we know from the from January 1st through January 27th, that's going to be the remaining days. So 45 minus 18. That is the remaining 27 days of interest. So if we take our $9,500 times our interest rate of 8% times 27 over 360, we'll arrive at the interest revenue for the period up from January 1st through January 1st through January 27th. So if we plug that in our calculator, we get $57. So we recognize $38 of interest revenue in December And then we recognized $57 of interest revenue from January 1st to January 27th. So how much cash are we getting paid from our customer? $9,500 plus 57 plus 38. The customer is paying us $95.95. We get paid principal plus interest. And then we're timing our interest revenue in the year it was earned. So we only have to do this crazy interest accrual thing when we're crossing a year. All right. So moving forward, in March, we originated a couple more transactions. So in March, they tell us that on March 3rd, we accepted a note. So on March 3rd, we accepted a $5,000 10% 90-day note, granting a time extension on the past due account receivable of the Thomas Company. So the Thomas Company didn't pay their account receivable, so we said, okay, now we're going to issue you a note, and we want you to pay us interest. So March 3rd, we're going to debit note receivable, credit accounts receivable by $5,000. And then on March 17th, we had another note. Same thing, note receivable, accounts receivable, and this was for $2,000. Now on April 16th, it looks like it says Chang dishonored his note. So Chang is the $2,000 note, and Thomas is the $5,000 note. So Chang dishonored his note. So on April 16th, we're going to move his note from note receivable back to accounts receivable. And in the process, we're going to recognize the interest revenue. So what dishonoring a note means is Chang didn't pay. So we hit the due date, he didn't pay. So we can't have notes receivable on our balance sheet that are past due. So we're taking it off of notes receivable, putting it in accounts receivable, and then we're going to recognize interest revenue along the way. So we know that we have to take the $2,000 off of notes receivable for Chang. Now we're going to calculate what interest would have been on the note. So if we take our $2,000, our interest rate on Chang's note is 9%, and we multiply that by 30 days over 360, we get interest of $15. So even though we're dishonoring the note, he didn't pay, we still get interest revenue of $15. So now the amount that we're moving to accounts receivable is $20.15. So we're reducing notes receivable by $2,000 because the note's past due, it's dishonored, he didn't pay. We're moving it to accounts receivable and adding our interest revenue along the way. So now we get to May 1st, Chang didn't pay. So now we're going to write off Chang's accounts receivable. So we know that when we write off, we're going to debit allowance for doubtful accounts, and we're going to credit accounts receivable. But the amount that we're going to use, it's not $2,000 anymore, it's $2,015. So now we're at the point, Chang didn't pay at all, we give up, so now we're just going to write it off. All right, and now on June 1st, we received payment from the Thomas Company from the March 3rd note. So what did he pay us with? He paid us with cash. We have interest revenue, and then he fulfilled his note receivable. So to take the note receivable off the books, we're going to credit $5,000. we have to calculate how much interest they're going to pay on the note. So for interest, we take $5,000, the principal value, times the interest rate of 10%, and then we're going to multiply that by the payment terms, which was 90 over 360. So we take 90 divided by 360, which comes out to be 0.25. Multiply that by 10%. Multiply that by 5,000. We get interest of 125. So our interest revenue on June 1st when we got paid is 125. So the total cash that our customer paid us is the principal of 5,000 plus the interest revenue of 125. We get paid principal plus interest. All right, I hope this was helpful. Please feel free to reach out if you have any other questions.